Subscribe to my channel Report Stock.
Every day we're just flooded with headlines. Sales up, profits down. It's hard to know what it actually means. So, here at the Deep Dive, we try to cut through all that noise, give you a kind of shortcut to understanding what's really going on. And today, we're diving into a company that, well, touches almost everyone, Walmart. Specifically, their Q2 results for fiscal 2026. And the headline itself is intriguing. Sales beat estimates, but earnings missed. How does that even happen? Billions more in sales than expected, but somehow they fall short on profit. That's what we want to unpack.
Right. And it's much more than just numbers, isn't it? I mean, these results, they really paint a picture of consumer behavior right now, plus Walmart's own big strategic bets and just how fast the whole retail world is changing around us. So as we get into it, we'll try to connect the dots, see the why behind those headlines and what it might mean for you.
Okay, yeah, let's tackle that core paradox first, the sales numbers. I mean, total revenues jumped 4.8% year over year. That's huge. $177.4 billion. That easily beat the Zacks consensus estimate, which was what, $175.5 billion. So on the surface, that looks great. Demand seems really strong. But then there's the other side of it.
That's exactly where it gets interesting, because despite that, really strong top line, adjusted earnings per share only nudged up 1.5%, just 68 cents. And crucially, that missed the estimate of 73 cents. So what it shows us is a company that's fantastic at bringing money in the door, but it's facing real pressure on keeping it, or perhaps making deliberate choices to spend heavily right now.
Right. So it's not just about making money, it's about the profit margin, how much you actually keep. And yet, management, they seem almost confident despite this miss. They actually raised their forecast for the whole year. Isn't that, well, a bit bold right after missing expectations?
It is bold, yeah. And it sends a clear message. They believe in their long-term plan. They didn't just hold steady, they actively lifted their fiscal 2026 guidance for both sales and adjusted earnings per share. It suggests they see this Q2 earnings dip as maybe a planned cost of doing business related to investments, not some underlying problem. They're basically telling investors, stick with us, this strategy will work.
Okay, so if sales were so strong, where did that nearly 5% jump actually come from? I mean, what parts of the business were really driving that $177 billion figure? It doesn't just happen by magic at that scale.
Well, the data really points strongly towards two things. Their digital efforts are accelerating, and they're diversifying how they make money. Global e-commerce sales, up a massive 25%.
Wow, 25%.
Yeah, and a huge chunk of that is their store-fulfilled pickup and delivery. Click and collect, home delivery run from the stores. It shows people aren't just going back to old habits. They really value that convenience, that hybrid model.
And it's not just selling stuff online either, is it? It seems like they're pushing into other areas too.
Precisely. Think about their advertising business. Global advertising revenue was up a staggering 46%.
46%.
46%. And membership income, think Sam's Club, Walmart, plus that grew globally by 15.3% as well. These aren't side hustles anymore. They're becoming really central to Walmart's growth, building this whole ecosystem beyond just selling groceries or TVs.
So for you listening, this translates directly into what you experience, right? Faster delivery, maybe more targeted ads when you're on their site or app.
Exactly. And more reasons dangled in front of you to maybe sign up for Walmart Plus or keep that Sam's Club membership going. It's about locking you into their system.
Okay, all right. Let's pivot to the other side then, the profits. If sales were booming, digital's flying, why did earnings miss? What were these sort of hidden costs dragging down the operating profit?
Yeah, this is where you see that classic tension. Investing for growth versus delivering profit right now. Their operating expenses deleveraged. That's the key term here. By 64 basis points.
Meaning costs grew faster than sales.
Exactly. Almost 20% faster in terms of the rate. That puts a squeeze on margins. And the reasons were, well, a few big things. One was higher self-insured liability claims in the U.S. Things like accidents or other insured events. Then there were significant investments in technology. That's a big ongoing cost. And finally, substantial wage increases, particularly hitting Sam's Club across the U.S., Canada, and Mexico.
Okay, so it's a mix. Some things may be less controllable, like claims. Others very deliberate, like tech spending and rising wages. But how do we know those are smart investments versus just costs getting out of hand? Could it be a sign of inefficiency creeping in too?
That's always the million-dollar question for huge companies, isn't it? And there's another layer here. Their unadjusted operating income actually fell 8.2% down to $7.3 billion. That was hit by some specific one-off legal and restructuring costs.
Yeah.
But if you look at it on an adjusted basis, and importantly, at constant currency.
Constant currency meaning taking out the effect of changing exchange rates.
Precisely. It gives a clearer view of the core business performance. On that basis, adjusted operating income was actually up, but only just 0.4%. So stripping out the one-offs and currency swings, the underlying profit was still growing, albeit very slowly. This suggests that, yes, while there were unexpected hits, a lot of the pressure is coming from those planned strategic investments.
Okay, so for you, the listener, it's like sometimes the price of getting faster delivery or maybe seeing employees paid better shows up short term as lower profit for the company.
Right. It's an investment they hope creates value, happier customers, better workers, more efficiency down the road. It's a bet, really.
Let's zoom in even more then, because Walmart isn't just Walmart. It's got different parts. Walmart US, International, Sam's Club. How did those individual pieces do? What does that tell us?
Yeah, looking segment by segment is really revealing. You see quite different stories playing out. Let's start with Walmart US, the biggest piece. Net sales there grew 4.8%, hitting almost $121 billion. What drove that? Mostly grocery and health and wellness. Those staples are really holding up. Comparable sales in stores open at least a year were up 4.6%. And that came from both more people shopping and people spending more each time they shopped.
So, more visits and bigger baskets.
Exactly. And critically, e-commerce within the U.S. jumped 26%. Again, driven heavily by that store-fulfilled delivery and their online marketplace. Operating income for Walmart U.S. was actually up 2%. They managed inventory well, which helped to offset some of those higher claims costs we talked about.
Okay, so the core U.S. business looks pretty solid, especially with that e-commerce integration really firing.
It does. Now, Walmart International is interesting. Net sales looked okay, up 5.5%. But remember, constant currency.
Ah, right. How did it look without the currency effects?
Much stronger. On a constant currency basis, international sales surged 10.5%. That's a huge difference. Almost $1.5 billion just wiped out by exchange rates. The growth came mainly from strong performance in China, their Flipkart business in India, and Walmex in Mexico.
But what about profit internationally?
That's the catch. Even on a constant currency basis, operating income decreased 2.8%.
Right.
Why? Strategic investments again, pouring money into growth initiatives in India, Canada, and Mexico, plus those currency headwinds still had some impact even on the adjusted number.
So growing fast internationally, but it's costing them in the short term to build that presence.
Seems like it. Investing now for market share later, likely accepting lower margins for a while.
And Sam's Club.
Sam's Club US, excluding fuel, saw net sales increase a healthy 6%.
Yeah.
And their e-commerce was also on fire, up 26%. Membership income was strong too, up 7.6%. Good member growth, good renewal rates. People are sticking with their memberships.
Sounds great, but what about profit?
Yeah, there's the other shoe. Sam's Club operating income dropped significantly, down 15.8% year over year.
15%? Wow. That must be the wage increases primarily.
Almost certainly. Given the timing and scale, those wage hikes across the U.S., Canada, and Mexico seem to be the main driver behind that big profit hit at Sam's Club.
Man, that really shows how different parts of the same company can face totally different pressures, doesn't it?
Absolutely. What's happening in Walmart U.S. grocery is different from Sam's Club's cost structure, which is different again from investing in Flipkart in India. It's complex.
So wrapping all this up, the big sales, the digital wins, the profit squeeze, these varied segment results, what's the final word from management? What's their outlook for the rest of this fiscal year, 2026?
Well, despite that Q2 earnings miss, they're projecting confidence. As we mentioned, they actually raised their full-year guidance. They now expect consolidated net sales to grow between 3.75% and 4.75% for the year on that constant currency basis. That's up from what they predicted before. And they also boosted their forecast for adjusted earnings per share, now expecting $2 to 52 cents to $2.62 for the full year.
So even after taking the Q2 hit, they expect the rest of the year to be strong enough to beat their original annual target.
That's what the guidance implies, yes. They did mention a small expected benefit in Q3 from acquiring Vizio, the TV company, but the overall lift suggests they believe their core strategies are gaining traction.
It feels like a pretty defiant stance after a miss. Are they just trying to manage market perception, or do they really see that much underlying strength?
It's likely a mix, but leans towards genuine confidence, I think. They see the momentum in e-commerce, advertising, membership areas where they've invested heavily.
Hmm.
They seem to be betting that these initiatives will keep delivering, offsetting those higher costs and driving better results in the second half of the year. It's a signal that they're committed to the long-term payoff of these investments.
So for you, the takeaway is that Walmart isn't backing down from its current path. Expect more digital innovation, more focus on delivery and membership.
Exactly. They seem locked into this strategy of building a convenient, integrated ecosystem, even if it costs them some profit margin in the near term.
Yeah.
You'll likely continue to see that play out in how you shop with them.
And just like that, we've taken a deep dive into Walmart's Q2. It's quite a story, isn't it? Soaring sales, amazing digital growth,
Yeah, driven by things like pickup, delivery, advertising.
but then balanced against those strategic costs, the investments in tech and wages and operational hits that caused that earnings miss.
It really highlights how a company's financial picture is, well, rarely simple. It's always this blend of wins, challenges, and deliberate bets on the future. And, understanding those different layers, that's how you really get informed about these huge companies that shape so much of our economy.
Absolutely. And for you listening, it's just a great reminder that behind every simple headline earnings miss, there's always a much richer, more complex story. Understanding that gives you, well, a real edge.
So maybe here's something to think about, a final thought to mull over. How might Walmart's strategy right now, choosing to pour money into digital ads, even higher wages, sometimes at the expense of immediate quarterly profit, how might that fundamentally change retail over the next, say, 5 years? And more personally, how might it reshape your own shopping habits and what you come to expect from retailers in terms of convenience, service, maybe even cost down the line? What does that long-term investment really buy them and you?
Subscribe to my channel Report Stock.